Hi there, I'm Leighton Roberts, one of the co-founders and co-CEOs at Sharesies. Today I'm going to be joined by Scott Phillips from the Motley Fool. We're going to spend a bit of time looking back over the past 12 months and also do a bit of stargazing into 2024. Plus we're going to answer the questions that you've sent through to us. But before we get started, I'd like to acknowledge the traditional custodians of the land, water and sky on which we come to you from today. That is the Gadigal people of the Eora Nation. And I'd like to pay my respects to their elders, past, present and emerging. Also, a quick disclaimer. Investing involves risk. You aren't guaranteed to make money and you might lose the money that you started with. We don't provide personalised advice or product recommendations, and if we mention a particular investment or product, it's just an example. Any information we provide is general only and current at the time we provide it. If you need help with your investment choices, we recommend talking to a licensed financial advisor. So let's get into it. Scott Phillips is the Chief Investment Officer at the Motley Fool Australia. If you follow Sharesies on Instagram, you will have seen him with his weekly market updates. Welcome, Scott.
Leighton, g'day. Great to be with you, mate. And yes, as you rightly point out, we are also only a general financial advice licensed organisation. So similarly, whatever we do discuss is absolutely general advice only.
Look, let's get into it. So let's go back in time for a little moment. When we began in 2023, look, I don't think any of us knew what was coming for us. Like I did have a crack at predictions, and I'm not sure that I was too flash on them. I tend to always err on the optimistic side of life, which is important, I think, but it does mean that some things can take you by surprise. So anyway, were you brave enough to make any of these predictions? And if you were, then what are the parts you got right?
Yeah, you've already mentioned your own predictions, so I'm going to say this carefully and cautiously without trying to offend too much. One of my favourite quotes is John Kenneth Galbraith, who says, he said, "Pundits forecast not because they know, but because they are asked." And I really like that idea of just kind of, no one wakes up and thinks, I think I know what's going to happen this year. But as soon as you're in a job like mine and someone says, so what's going to happen to the ASX this year? Or where to for interest rates? Then they kind of think, well, I've been asked and I'm supposed to be an expert, so I guess I might have to formulate an answer. And that's kind of harmless enough in itself. Where it gets messy is when people then try and make money trying to follow these predictions, right? Because they're just, you're betting against somebody else. Realistically, no one knows either. As soon as you have two experts with different views, unless one of them is completely stupid, it's probably just luck that determines the outcome rather than anything else. So being an optimist, I think, is super smart, as you say, super important, almost a necessity if you're going to invest well for the long term. I didn't make any predictions, mate. I did. So I'll claim half a bit of prescience a little bit. The inflation rate that we saw increasing in the US first was a bit of a preview of what Australia might happen. I think I might have tweeted at the time something like, I hope we're not seeing a preview of our own movie. You know, that idea of, hey, it's happened over there. Will it really stay over there? The Reserve Bank famously thought it would. They'd said, you know, oh, it's just a global thing. It's US only. Maybe it won't come to Australia. I think that was probably, speaking of optimistic, I think that was way too optimistic, unreasonably so, to believe that somehow we could escape that global stuff. So I did worry. I won't say I predicted it because I didn't, but I did worry, and I made that worry public that we might be seeing the movie played out before we actually have to live through it here, and that did come to pass. I will also say I didn't think rates would get this high, interest rates. Again, so I didn't make the prediction, but I kind of thought through, you know what, if it gets much higher, it's really going to put households under serious stress, risk a recession, risk people losing their homes. The RBA in the end had no choice, or figured it had no choice, and so here we are. So I don't know if I'm not sure where I'm going to go in terms of that. I probably also thought the market might do a little bit better. I thought the pessimism might lift a little more quickly. It is worth saying, by the way, I'm pretty sure I did this numbers a week or so ago. The top performing sector on the ASX in the last 12 months, I reckon if I asked people to guess, I don't think too many people would. Healthcare was number one. Number two was consumer discretionary. So in an environment where the economy's slowing down, people say, well, hang on, I thought things were going to go badly. And how is it that, you know, Harvey Norman sales famously down 12%. I own shares for full disclosure. Down 12% since July 1 to about 25th of November. And you go, hang on, well, if discretionary economy is in free fall, how do discretionary retail stocks up? And the answer is the market isn't the economy isn't the market. And it's important to kind of keep that in mind as well. So I don't know, mate, if I'd made those predictions, I might have been 1.5 out of 4. But no, I didn't make predictions. A reminder, I suppose, of the folly of doing so.
Yeah, no, I mean, I agree with you on, when I was thinking about it, I was sort of thinking for my own impact, you know, what's gonna happen here. Interest rates is one that surprised me. It's these things where you, in some ways, you need to make a decision. Am I going to fix this or am I not going to fix it type thing? And if I am, how long for? And within reason, you're making some sort of predictive comment or judgment there, right? And I was as it turns out, a bit foolish in the 1%, but you never know. And as we touched on, that optimism is important. And if you're going to be investing, you have to believe in a growing future, or at least and growing economies. Or I always think you've got bigger things to worry about than how your investments are going anyway.
Correct.
Anyway, interesting that you touched on that movie that you saw play out. So I wonder what you think about that movie at the moment. Because if we look at the US market, S&P 500, and it does tend to, the Australian market lag the US reasonably quickly actually, but if we look at it year-to-date results, we're up 19% on the S&P 500, just a bit over actually, and ASX 200 more like 1% I think year-to-date. So any thoughts on that?
Yeah, lots actually. And I think this is, I find the ASX really difficult. I'm an ETF, I love ETFs, right? I'm a stock picker by trade. And again, as I said, I don't have a company line to push here. If I was going to push a company line, I'd say go away from ETFs, actively pick stocks, and hey, the Motley Fool can help you do that. I don't have to say that, thankfully, so I don't. I think ETFs are wonderful. Like, they're such great tools. The passive, low-cost ones I'm talking about here, not the thematic ones. They're just awesome things. The challenge for Australian investors, or investors investing from New Zealand in Australia, is our market is dominated by two massive sectors: finance or banking and mining. And so you kind of got this. And the broad cost of money. Think about interest rates, as I said, the fancy algorithms and maths that some investors do. That is kind of global. But the reality is, when more than half of your market is in two sectors, and those two sectors are either great or terrible, you're going to see divergence between the ASX and the US. Now, add to that, in the US, the so-called Magnificent Seven, the 7 biggest companies in the US that are responsible for almost the entire gain of that index, are almost entirely tech or tech-related businesses. So on one hand, tech and tech-related companies in the US, on the other hand, banks and miners here. When those fortunes diverge by sector, you will get really divergent returns on the market. So which is not to say you shouldn't invest in an ASX ETF, by the way. I have one. I think people should as part of their portfolio if it's right for them. But it is worth being mindful of the fact that sometimes we will see the ASX zig while the US zags, or vice versa. Other times it'll march in lockstep, right? Just because that's the way these things go. But you just have to be mindful that, by the way, it's a great reason to diversify internationally. But if you think about the ASX specifically, very much been driven by those two sectors in any direction. In this case, almost no direction. In other words, as you said, pretty much dead flat. But that's a story of the market composition, rather than maybe the economy itself, or even the fortunes of the businesses themselves, and certainly lots of different puts and takes inside that.
Yeah, you touch on the Magnificent Seven, the technology impact. We know that technology was hit first, tends to be as a growth stock normally, as opposed to your dividend paying. You mentioned the big blue chip type industries that we have in Australia driving that. Why do banks not do much better out of these environments, when we all know that bank margins and profits tend to like higher interest rates?
What I love about the question, mate, is it's the question, or the assumption that most people would make. And I think what it reminds us is that there are different component parts to any business success story, or frankly struggles, that aren't just the kind of first line of thinking. So you're absolutely right. In a normal market, what you should see is the so-called net interest margin. It's a metric that's common just to banks, or particularly just to banks. It's basically the difference between what the money costs them and what they sell it for, right? Their inventory is money, which sounds weird, but they pay us to put money in term deposits. They pay the wholesale money markets for access to capital. They lend that out at a higher rate, and they get the difference. So it makes sense. They're making a margin on that, same as any retailer would. They're effectively retailing money. So that normally should expand as we see interest rates grow up, because when you're paying zero for deposits already, because you can't pay less than that, you could charge people to put money in the bank, but that'd be a hard one. So you've got a hard floor on deposits, right? As the increase in loan prices, interest rates, goes up, that gap can get bigger as long as the deposit rate doesn't come up at the same pace. So the higher loan rates are, the more potential there is for margins to be made. Now, two things are happening right now in banking. The first is competition is actually working reasonably well, despite the preconceptions sometimes that our politicians like to fan the flames of. Competition's working. the banks' margins are actually falling because they're competing harder with each other for business. So when you've got rates going up, the margins tend to expand, all things being equal. But of course, as the economists will tell you, not everything is equal. And so you've got two things going on. The first is that competition issue. The second is we're not seeing meaningful increases in house prices or lending volumes. And so if you've got growing margins, or you have the potential for growing margins, if everyone's getting a lot of business, if property loans were growing, if business loans were growing quickly, all the banks would be happy to say, you know what, we'll take our share, we won't compete too hard on price, we're all a bit more prosperous, let's not work too hard here, guys, let's all bank the savings. That would normally happen in some markets. Right now in Australia, you've got business loans not growing, personal mortgage loans, not growing, and so they're fighting really hard to gain and maintain market share. And so the margins are falling despite the fact, as you say, that orthodoxy suggests they should be increasing, all else being equal. And it's just a thing. The last one quickly is bad debts. So because we are in tougher economic times, the banks are increasing their allowances for bad and doubtful debts. In other words, the chance that their borrowers won't pay them back. And that is also depressing profit margins. So where it should be the best of times, it's not quite the worst of times for banks, but profit growth is incredibly, incredibly hard to come by. I think CBA grew by 1%. I think that's right in the last reported set of numbers. So it just goes to show how tough they're doing it, how hard they're having to fight. Now, when you've got that, if you can only grow your profits at 1%, no surprise, the share prices aren't going to go through the roof. And again, when banking is the biggest part of the ASX, we're back to that point of why is the ASX lagged? Pretty directly because the banks are doing it tough.
Yeah, great answer. Thanks, Scott. And all else is not equal, is it? That's one of the things. The rules don't tend to play out. There's always some other factor in there, and sometimes many different factors, and it's hard to work out which one's driving which. But you think about some things. There are segments of the economy, people who are pretty happy to see some higher interest rates, and you think retirees, etc., or people who hold a lot of money in cash were starting to think they might be eating through that, and that's changed very quickly with regards to planning. And yeah, interesting, you touch on those loss rates and the provisioning that's happening at the moment, all at much higher levels than what we'd seen. So for anyone listening out for that word provisioning, that's the bad debts and stuff that we're talking about here that coming through, and people less capable now of paying their loans, and we're seeing that across the economy actually in housing and businesses. So just some interesting stats actually, which has happened over the last 12 months, not really for comment, but something I found interesting. ASX is still the most popular for the investors using Sharesies. It does about 50 to 60% of the trades, on any given week are going through the ASX, but the US's preference is growing. So that's actually the US trade volumes have more than 5x'd over the last 12 months, which could be something just with that interest in in those growth stocks and a bit of opportunity taking, which is interesting.
Yeah, I think it is. I think it's really important to, a lot of your users are using Sharesies to access the US market. I think it's really important. I'm a massive fan of international diversification. We've already kind of mentioned, I have been for years and years and years. The Australian market is great. The Kiwi market is great. There's some wonderful businesses, and it doesn't need to be an either or. It's not a patriotic or nationalistic conversation here. The question is really, where are the best places for your money? I used the example before, Leighton. I don't know if I did it on the podcast, but when we last spoke, but it's like going to a real estate agent and saying, look, I'd like to buy a house, but please only show me houses in streets that start with the letter B. You say, well, why would you do that, right? And so as an Australian, as a Kiwi, you say, well, I want to invest, but I only want to invest in 2% of the market capitalisation of the world, which is Australia, and the New Zealand market's smaller again. Restricting yourself arbitrarily. If an alien came from space and said, I'm going to pick those two little islands down there, I'm only going to invest down there because I don't know, that's where I landed the rocket ship. You kind of go, well, okay, but it doesn't make a whole lot of sense. Which is not to criticise people who are just investing domestically or just trans-Tasman, but think about some of the great companies that are overseas. The diversification, purely diversification alone is enough. Currency, industry, geography, really, really powerful. So, well, hang on, do I really not want to even look at those because they happen to be traded somewhere else? The democratisation of brokerage that you guys and plenty of others besides have really made access to international markets so much more accessible. I think it's a huge, huge boon for your customers, your members, and investors in general. So I know I'm not here just to make you guys sound good or tell you how good you are, but I think it's important. I think if you've got people who are considering investing internationally, maybe in terms of a New Year's resolution, that might be one I might suggest.
Yeah, nice. I remember great piece of advice I got from an investment advisor once was, look, you've got your house in New Zealand if you're, and you've got your job in New Zealand, and do you want your investments there as well? That's a lot of risk you're in there and diversification. And I personally do like a bit of a home bias. It's great to invest in companies that help grow personal economies, but that diversification is key. And you're right, the opportunity outside. So what do you think the top 3 events that have shaped the markets this year, and with AI in particular, do you think it's peaked?
The easy answers are inflation, interest rates, and AI. I think that they're probably the 3 dominant issues. I will throw the Ozempic thing in, actually, just kind of as a talking point, rather than necessarily impacting markets per se, impact of specific stocks, but it's almost a teachable moment in itself. Let's do AI, because you kind of ended there, and I'll pick that one up. Frankly, I should be asking you, mate, because here's my gut feeling about AI. Other than businesses like Nvidia, and when I say other than, it's a massive business that's done extraordinarily well, so I don't mean to just dismiss it with the stroke of a pen. But other than Nvidia, I think AI is probably, speaking of predictions, probably going to end up more like the internet than anything else. And the analogy here is the internet is an enabling technology. Now, has anyone won the internet? No. Some people have used the internet really cleverly, either for new business like Amazon, for example, or again, I'll use another one I want to talk about. Berkshire Hathaway. Geico is a car insurance business in the US that Berkshire Hathaway happens to own. They have revolutionized their business, brought costs down by using the internet to sell insurance policies, right? And everything else besides. Now, does Amazon exist without the internet? No. So is Amazon the internet? Does the internet itself, its existence, could you have bought the internet and made money? And so I think the answer is obviously no. So I think what I would encourage your people watching and listening to think about is the value of AI as an enabling technology with vast potential, incredibly vast potential. And why I say I should ask you is because businesses who harness AI, use it well, will, I think, have huge opportunities. But I don't necessarily think someone's going to own AI in the same way no one owns the internet. Walmart could have jumped on the internet as well as at the same time as Amazon and absolutely crushed Amazon. Amazon wouldn't exist today if Walmart had been faster off the blocks. Blockbuster could have bought Netflix or competed with it. But instead it said, no, we're in the video rental, physical DVD rental, VHS rental business. No, thank you. You guys do your own thing. It wasn't the internet. It wasn't like Netflix was the only people who had access to the internet, or Amazon was the only one who had access to the internet. It was the ability to see the potential and use it to create value for customers, as like anything else in business, that I think makes the difference. So this is seismic, potentially. It is, the opportunity is enormous. The machine learning, just the speed, the breadth, it is really, 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 really super cool. But I don't know that, maybe aside from NVIDIA, there will be pure AI companies that necessarily stand to benefit. And Microsoft already bought part of OpenAI that did ChatGPT. Will Microsoft benefit from that? Probably indirectly. Will ChatGPT be the final winning chatbot? I don't know. Will it be any, or will they be all the same? I don't know. So I wouldn't necessarily try and find pure AI winners. I think I would look for businesses that are harnessing AI, using it well. What I expect is those businesses will start to open a gap between them and their competitors. So I think it's a massive opportunity for change, huge threat if you get it wrong too, by the way. So investors need to be aware of this. But as it continues to roll out, I suspect it'll be those who use AI well, rather than AI itself, that makes the fortunes for investors.
I'm super interested to play out, and I couldn't agree with you more that it's what companies are using it, how well are they using it, and who's going to harness some of that power first and fastest, and in a way that's not detrimental to them, because we know there's still lots of misunderstood risks at the moment, and see when that could go.
Yeah, that's true.
Anyway, thoughts on, you touched on the other two, inflation and interest rates. Anything you want to sort of touch on them as?
Yeah, I mean, look, I feel like they've been done to death, but I also feel like they are really, really, really important. Again, I'll do them in reverse order, mate, not just to be contrary, but just because it kind of comes to my mind that way. I would suggest that people need to remember that interest rates are probably now going back to the old normal, not to a new normal. I guess what I mean by that is there are people who I used to, only 18 months or so ago, paying meaningfully less. The Australian official cash rate was 0.1, it's now 4.35. That difference, people may say, well, this is going to be a new peak, and it'll go back down again to something below that, back down to 0.1% again or something, and that will go back to the old normal. I think what we will find, and by the way, this is half a prediction, but also more mean reversion, or just looking at history and saying we're probably likely to repeat that than change. the historically low interest rates of the last 2 decades are probably going to be the exception rather than the rule. And so as we go back to what, even lower, frankly, than historical averages, still, even despite how painful it's felt and how it's hurt people on the way through, it'll come back down from this point probably because of the realities of debt and the amount of debt that people have, particularly in mortgages. But expect that this is more new normal than exception to the rule. And yes, it'll probably come down from this at some point, may go up first, we don't know yet. But as that kind of cycle plays through, just kind of keep that in mind. The value of money is important, so think about the impact of interest rates, on some of the startups, some of the companies not making any money on the ASX that have been absolutely smashed because investors said, we used to not care about profits because interest rates were zero, all we wanted was growth. Now all of a sudden, 12, 18 months later, it's all about profits and don't worry about the growth, thanks very much. And companies are feeling a bit whipsawed by that and think, well, hang on, what am I doing here? All of a sudden, you're wanting me to grow really quickly. Now you want me to slow the growth down and make some money. Which one is it? And the market's fickle. So as investors, we need to be mindful that you don't have to necessarily try and predict it or follow it. Full lifetime value will come out from those companies over time. It might be a rockier road than might have otherwise been the case, but if you've got the next Xero, for example, the cloud accounting business, it went through some huge ructions in share price. It was up to 40, down to 10, back to 120 or something. Huge volatility over its corporate lifetime thus far. That is the exception, not the rule. So kind of just be mindful of the way sentiment impacts share prices, and in this case, driven by interest rates in particular. The next one, probably the last one, is inflation. And I think we've, again, been reminded, it's one of those things, corporate memories are very short, as are investor memories. I reckon economists and investors probably have the shortest memories of most people. We repeat the same mistakes every 7 to 10 years. The hubris of 2006-7 was probably revisited in 2016-ish. Again, probably pre-COVID. These cycles tend to happen regardless of how much we think we know about them, because human nature is human nature and we're all flawed, emotional human beings, so that's just the way we go. But if you think about that, just a reminder that, again, speaking of old normals and new normals, we managed to have no inflation for the best part of 4 decades, but for the couple of decades before that, it was really high. We had the oil shock, stagflation, all those things. Helps not having a bit less hair than other people. I've been around for a while. The benefit of knowing that sort of stuff is a reminder that these things do happen, cycles happen, these things come and go, and just keeping that in mind. So I don't know how long it takes for inflation to come back down to the RBA's target range. I would suspect it'll probably be quicker than many think, not as quick as some hope, somewhere in between, because normality will be returned at some level. Hopefully, inflation can be kind of consigned again and eventually to the rubbish bin of history, at least for a few more decades, but I wouldn't bet on it, right? So allowing for the fact these things can and do happen, what do you need to do to invest in a world where inflation is actually a thing? And so think about the sort of businesses you want to own. Think about the attributes they might have. How do you keep up personally and financially with inflation? Those things we didn't have to worry about for the best part of 40 years. All of a sudden now they're back with a vengeance. It was probably the right investing approach to pretend or to believe they would return at some point anyway, but now they're definitely here. Just thinking about the businesses that will thrive, and those may not. They may be different businesses, they may be different industries, sectors, management styles, company attributes that exist now that are all of a sudden far, far more important than they were even 2 or 3 years ago.
Yeah, nice. That's great. Like, as someone who has had most of my home loan in a very low interest rate environment, it's certainly a shock. But prior to that, prior to my life at Sharesies, I was actually running a home loan book, and I certainly never priced anything with 2s or 1s in front of it. So right. I don't know why it's. So I don't know why I was so shocked, to put it that way, but that's how it happens, isn't it? Hey, just some interesting stats actually. It's interesting just over the last 12 months, some of the changes that has happened. So confidence does seem to be looking back. Sometimes markets can lead confidence back, or as an early indicator of it anyway. Obviously sentiment's driving that first, but we've certainly got net buying back on. So in the last month, we're back to sort of 1.8 or $1.80 bought for every $1 sold, and that was much more even for the majority of this year. And the other interesting thing is over the last 12 months, which shows how much lower the markets were 12 months ago, but there's actually been a 65% increase in the funds held on the Sharesies platform for Australian investors. So some really interesting numbers, and show that there's still optimism there, which is good, despite the challenges. Look, I think You've touched on no predictions, which I think you rationalised that well, so I'm not even going to try. So instead, I'm going to I'm going to ask you a different question, which is anything that you think investors can keep an eye on, or things that investors should just remember heading into 2024.
Yeah, I love that actually. I think this is. Predictions are one of those things you can kind of, I think it's not unreasonable to, as investors, we all look forward, right? So when I say I'm not doing predictions, it's absolutely true. But on the other hand, whenever I buy shares, I'm saying I think this is cheap relative to a likely future for this company. And so I don't want to be too holier than thou. We're always looking forward and saying, how do I imagine this story might play out? And that does require you to have a view on the future. And one of my favorite phrases is I try to be roughly right rather than precisely wrong. In other words, a range of futures, if I can find a range of futures, think about business, investing, markets, whatever, and think about the likely path of progress, how things might eventuate based on history, my understanding of what's going on, consumer and company behaviours, all that kind of stuff. We are all in the getting ready for a future I think I might be able to roughly foresee kind of environment. And if that feels like I'm kind of weasel wording around predictions, I kind of am. But I'm kind of not, because I don't have a view on when it will happen or how big the impact will be at that point. Directionally, if I'm roughly right, I'm going to make more than enough money over time if I compound regularly, add money regularly, invest, diversify, all that sort of stuff. And I'm roughly right more often than not, I'll do very, very well. Not because I'm super smart, just because that's what compounding does. If you get that right, and you can really do quite well. Excuse me. So taking that forward, I think it really, you try confidence, and that's a really nice lead-in. I didn't know you were going to say that, but it's a perfect lead-in because I don't know where the bottom is for the Australian economy or for the world economy. I would suspect, however, that there are better times ahead than we're currently living through for a whole lot of businesses, particularly those exposed to consumer spending. I think discretionary retailers are going to have better futures than the current share prices imply. Why? Because markets tend to be short-term. But if I'm buying them at a low multiple, a low PE, or choose your own valuation metric, I'm buying those shares pretty cheaply based on the current expectation of the near-term future. So roll that forward. I think there's a lot of high-quality businesses that are going through temporary challenges, headwinds, and once they fall away, those businesses, assuming they remain intact and with the same competitive advantages and circumstances that brought them to this point, then they should continue to really, really nicely moving into the future. So the biggest, for me, 2024 watch out or opportunity, I think, frankly, for investors is think past 2024, ironically. You asked me 2024 views. I would say, as we end 2023 and go into 2024, which businesses are being priced as if the malaise will last forever? Because if it does, they're probably still fairly priced, frankly. They're that cheap. If it doesn't, if the future is much brighter, then you're probably offered something at a cheap price relative to that long-term future. So that's the first thing. I'll double down on retail in one specific way, Leighton, which is e-commerce. Now, I own some e-commerce companies. I own some companies that have both physical and digital presences. I think we've gone through COVID where we had e-commerce boomed because everyone bought online, people were locked in their homes and said, well, I'll buy it all online, thanks very much. Not surprisingly, when that finished, they went, oh, thank goodness I can go back to the shops. The novelty, the experience, or whatever, go back to shops, great. But if you take that out, and you think about the growth of e-commerce, what we call penetration, the number of people who are using it, the frequency with which they're using it, I don't think that's peaked. In fact, I think on a secular level, horrible jargony term meaning basically excluding cyclicality, the ongoing growth of e-commerce as a form of retail purchase, I think has a long way to go. We're behind the Yanks and the Poms. They are still only a third to 45% penetrated for e-commerce. I would suspect there is a very long way to go for Australian and frankly New Zealand-based e-commerce players. Now, if I'm right about that, then the last couple of years of people saying, oh, the e-commerce boom is over, we've forgotten about that now because the last year's worth of sales were negative, so therefore it must be all over and done. I also would suspect not only retail broadly, but e-commerce as a subset is going to do remarkably well. And then let me triple down on that quickly to say, be very careful with real estate investments. Those second-tier particular retail landlords, shopping malls, shopping centres, I would be very mindful that if I'm right and retail sales return to or continue to grow online, and we go through a tougher economic time where some of the weaker retailers may actually suffer and maybe even close some stores, if I'm a retail landlord with a fixed footprint and some of my tenants are struggling, either from a cyclical current slowdown or in a secular basis because they're not going to need that many stores or they're less relevant compared to their online peers, I'd be very worried about who I'm going to have in those stores, how much I can charge rent, all that kind of stuff. There is some great retail-linked property trusts I think are worth investing in. Some of the bulky goods guys, like the warehouses or the homemaker centre type places. But if you're doing bread and butter retail and you've got tens, scores, hundreds of stores, and the online growth continues, some retailers now, a quarter, a third of their sales, even with those bricks and mortar retailers. Myer, one of the oldest businesses, big kind of boring, lazy. I don't want to offend anybody, but up to a third of their sales were online recently. And you kind of go, man, if Myer's 1/3 online, imagine those, the ones that are targeting younger customers, more tech-savvy customers, imagine their online presence, and then fast forward, that'll play that forward far enough. I just think that dynamic, I think, is still playing out. I think it'd be a shame to miss the forest for the trees, or more importantly, maybe get dissuaded or discouraged by the short-term cyclicality and volatility and miss the bigger long-term story.
No, great insight. And I was thinking while you were talking there, it's like we're talking in terms of adoption, right? And that can take a long time. And within reason, we're still in early adopters. Maybe we're into the next wave of adoption there, which is given COVID and that accelerated people, but they were already tech savvies, so there was still lines and lines at the supermarket not using the online shopping. And then of course the second thing is the investment infrastructure to make retail, it's getting faster and faster to get whatever that is delivered, and there's a whole lot around it. So that's really interesting insight. You were just talking just before that on, thinking about the next year, sure, but what about the next 10 years or however long that is? And just some interesting stats that came out of a recent survey we did with our Australian Sharesies investor survey. So 70% of the respondents were investing for 10 years or more, ticking in that bucket, which always gives me a lot of confidence, because when I am talking to anyone about investing, and I say long term, and you read 5 to 10 years or something somewhere, I'm like, that's not long term. That's just like that happens to you before you know it. She's 7 years old now. That freaks me out all the time. I've got a 5-year-old at school. She's nearly 6. Mad. Just look at kids and see how quick time goes, right? A few other interesting things about the future. So over the last 12 months, 50% increase, or close to 50% increase in those investing in the ESG-based ETFs, which I thought was fascinating. And another interesting thing is just ETFs broadly. You mentioned earlier you really liked them, but so does Sharesies investors. So an 81% increase in ETF holdings year to date, and that's versus 31% increase in individual companies. So it's interesting how this market is sort of coaching people, I think, into some quite sensible long-term investment strategies, which is really cool. Hey, I'm very conscious of time now, and have really enjoyed your time here, Scott, but we do have some questions from our followers on social, so I'd like to get through a few of those. Maybe we can quick fire them. So the first question is, what percentage of your savings do you think you should invest?
I've got two answers. I don't hold cash on the sidelines. I am 100% invested all the time where I can be, other than occasionally when I just kind of, like all of us, the plumber's always got a leaky tap. Sometimes I've got some cash adding up. But every payday, I put money from my transaction account into my investing account, and then I want to invest that as quickly as I possibly can. So investable portfolio, I'm 100% invested. Why? Because shares go up over time. We've already talked about that. But please do two things for me. Firstly, pay off any particularly high interest personal debt, but any personal debt in general, get rid of that, particularly at higher interest rates. That's money for jam, right? It's a guaranteed return of the savings you make by paying off your debts. So do that. Secondly, have a rainy day account. Now, this will freak some people out. 3 to 6 months of expenses in a rainy day account, just in case. If you lose your job predominantly, and particularly, frankly, going into this sort of economic environment, please do yourself a favour, have that money put aside. Not necessarily 3 to 6 months of wages, but of essential expenses. You can cut back on everything. If you lose your job tomorrow, you can cut back on everything, almost everything, right? But you've got to pay the mortgage or the rent. You've got to put fuel in the car. You've got to pay the insurance. So think about what those unavoidable expenses are. 3 to 6 months of those in a rainy day account, in an online high interest savings account. Yes, you'll forego the opportunity to invest it. The peace of mind is priceless. as is the opportunity to use that money if you need to, without having to be forced to sell down your shares, or worse, take out some of that high interest personal debt to try and get through. So get rid of the credit cards, get rid of the buy now, pay laters, get rid of all the personal loans, pay them off, get rid of them, cut up the cards, do what you need to do, save money, 3 to 6 months of essential expenses in a high interest online account, and then 100% of what's left over, I personally invest every payday.
Nice, great answer, thank you. Next one, compound interest with shares. How's that a thing?
It's a good question, right? So two things, two ways. Firstly, you can reinvest your dividends the same as you can reinvest your interest in the bank account. So the compound interest idea, we talk about compound interest as if it's the same thing. We should be talking about compounding. When we talk about compound interest, we're using just the generally accepted terms. Now, if you invest $100 in a bank account, you get your couple of percent a year, 100 becomes 102. Keep that in the bank account at 2%. You don't just get 104. The 100 earns 2%, but the $2 earns 2%. And then on and on and on it goes. We know how that gets bigger over time. So two things with shares. The first is any dividends that are paid, if you reinvest those into more shares, it's the same as leaving interest earned in the bank account. Second thing is companies tend to get bigger and better over time. Why? Because economies grow, because the best companies find new and better ways to solve new and existing problems. And so think about the growth of, pick an example, we talked about Apple. Its ability to, find new ways to sell people new and better technologies. The world's, knowledge in your pocket on a fantastic screen that's largely kind of not unbreakable, but less likely to break. Sell you the headphones that go with it, sell you the computer that goes with it, etc., etc., etc. They're finding new and better ways to solve new and existing problems. That over time, that growth is really, really good for company valuations. And the great thing about shares is it tends to be the case, not exclusively, the best companies in any country tend to be listed on the stock exchanges. Not all of them, and some of them listed on the exchanges are terrible businesses, by the way. But that subset, that kind of, you're almost getting the most of the cream of the crop. And then those businesses that are the best are probably doing a better job of solving those problems, and they're making more profits. Now, if they make more profits over time, that tends to correlate or turn into higher share prices. So put those two together, reinvested dividends and higher profits leading to higher share prices. That's how you get compounding working, not compound interest, but compounding working in your favor. It's been the story for the last 100 plus years. I mentioned the Vanguard index chart a lot. I don't have the New Zealand numbers, but 10 grand invested in the market in 1993 was worth 130 grand, 13 times your money in 30 years, just by leaving the money there, reinvesting the dividends and letting quality businesses do their thing.
Yeah, completely. Compounding returns. I've tried to change my language on that to avoid the confusion for people. That's great. The next one is, should my partner and I have separate portfolios or have one portfolio?
Marriage advice. You come to the wrong person. No, I'm kidding. Firstly, do what's right for you guys. It's a relationship dynamic that matters more than your individual circumstances. For what it's worth, my wife and I have a joint bank account and a joint investment account that works for us, and that kind of, I think, is... I'd say I think it's best because that's what I do, right? So everyone's different. Some people have different issues, different reasons to want to do things differently. I'm not going to tell you how to run your relationship or your personal affairs, but marriage laws, divorce laws notwithstanding, generally speaking, it's probable the courts will consider it one basket of assets anyway. If you are going to run them separately, though, I would suggest that if you intend to be together for a very long period of time, particularly if you've been together for a few years, do think about it as one portfolio, even if there's two separate ones. The reason I say that is because there's no point you saying, well, I own this much of company A, assuming you're diversified if your partner owns even more of company A, right? So considering it as one, even if you consider it two parts of one portfolio, just for the purposes of diversification, growth, the objectives you're trying to achieve as a couple, maybe it might be income, capital growth, diversification, I would really encourage you to think about that. Now, I'm not saying you want to necessarily let your partner's your portfolio govern what you put in yours or vice versa, if that's the way you want to run your finances, but just be mindful of it, because if you end up with too much concentration between the two parts of the portfolio, you may have risks in there that you haven't allowed for when it comes to diversification and stuff like that.
Yeah, nice, thank you. I always think behaviours trump everything else with money, right? So focus on getting those right first, and whichever one that works for you should be the guide. There's not too many other rules that, people tell you rules and stuff about money all the time, but actually if you haven't got the behaviours right, none of those matter. What are the best ways to learn the basics of investing, and how should I invest my first $1,000?
Best way to learn the basics, read. Read and do. I made some terrible mistakes early in my investing career. The best thing is when you're starting, you've got smaller amounts of money by definition. be realistic. Speaking of behaviours, understand that it'll be volatile, scary, you'll lose money, you'll make mistakes. Embrace that. Don't avoid it. If you're going into it expecting to be perfect from day one, you'll stop doing it. You'll do it for a month and give up because it won't go the way you want it to go. Grab a copy of the Vanguard Index chart, put it above your computer, put it on your bedroom wall, put it somewhere. Look at the ups and downs, the gyrations of the market. Remember that the short term is scary. The long term is remarkably profitable. Always has been. I can't promise it always will be because I'm not allowed to, and it'd be unethical to do so anyway. My strong suspicion, my expectation is the future will be bright, but we won't avoid the occasional gyrations, right? So embrace it, learn to ride the waves. Don't leave the boat just because it gets choppy. So do that. First $1,000, again, we can't give personal advice. Grab an ETF. Grab a broad, low-cost, index-based ETF. ASX 300, ASX 200, S&P 500, NASDAQ, Vanguard Global. There's other providers have global ones as well. I have no affiliation with Vanguard, by the way. I just like them as a fund manager, so I talk about them a lot. But it's not. I'm not getting paid. I'm not getting anything for it. Maybe they should be paying me, but they're not. So grab an ETF. It sounds boring, and it kind of is. But what it does is it gives you a platform to add more money over time. If you buy shares in a company with $1,000 and it goes down 15%, you've lost $150. You hate this investing caper. You've lost real money. You save really hard for that. What am I doing here? An ETF, by the way, that can still fall because markets can still fall, but inbuilt diversification, low cost, it's easy, simple, no big obstacles. Which company do I choose? How do I choose? This is way too hard. Jump in with an ETF. And then, by the way, over time, either add to that one, add other ETFs, and or add individual companies as your interest and your temperament allows. Some people I love analysing companies. It's just fun. Like it's really, I'm boring, I'm a nerd, I get it. But it's really fun, it's interesting to me, it's a challenge. I love that as part of it. So that's why I do it, right? But if it's not your thing, grab an ETF. What you need to do is make sure you stay in the game. Charlie Munger, I'll finish off with this, Leighton, died recently, Warren Buffett's right-hand man for 50 plus years at Berkshire Hathaway. One of his more famous quotes was, "The trick to compounding is never interrupt it unnecessarily." In other words, invest, keep investing, don't sell unless you absolutely have to. And if you do, buy something else, don't take the money out. Let your money do the work. Your future self will thank you for it.
Nice. That's a great way to finish with a great quote from a great investor. So we're going to wrap it up there. Thanks so much for listening, everyone, and sending through all your questions. If you're interested in learning more about the Sharesies app, then head to the App Store or Google Play Store, or check it out on our website, so sharesies.com.au. Finally, Scott, thank you so much for joining us and for joining us throughout the year. Super insightful as always, very knowledgeable. I've learned a bunch, and I'm sure the people watching have too. And to everyone out there, enjoy a good break, hopefully, and happy investing.